capital markets. It's of course a well-known fact he's become a very successful individual investor, and folklore has it around him that very, very strong fundamental basis of investing. But it took me into a journey post my MBA, and not many people know that I actually bought a stock exchange card in my name in 1985 and went into the ring. In those days, the ring was a physical ring, and buy, sell, all those signals which I learned. And then in that big ring, there was one corner where there was a lot of crowd, but only one market maker, broker. So I asked, because I was learning, कि वो corner में क्या है? So somebody said, वो चोर गली है. So I said, what does that mean? पूरा रिंग तो बड़ा है, but ये कॉर्नर चोर गली क्यों है? कि उधर illiquid stocks ट्रेड होते हैं और bid offer between 20 and 50%. And of course, the issues of illiquid stocks, lack of floating stocks, even in the technology world, remain. So I'm just trying to say that we may have been 45 years ago, but the issues which challenge markets in those days continue to be some of the issues which we deal with as we deal with the whole area of capital formation. So if I go back to the journey of Indian capital markets, I am actually amazed at the kind of progress we have made. What we are sitting here and seeing compared to those 80s is just mind-blowing. And I have to put it on record. I have to credit various governments across this period. I have to credit the formation of SEBI in 1992. From a point of time when people in the market practitioners used to say that SEBI has no teeth, to, I'm sure some of them may now be saying, is it too much? I'm not saying that. But that is the journey, friends, of last 40 to 45 years that we have seen the evolution of Indian capital markets. And I have no doubt and hesitation to say that the capital formation in India has a lot to do the development and regulation of capital markets by policymakers and regulators across generations of governments in the last 40 years. So a big round of kudos to the regulatory system and the policymakers. I saw the development of foreign investors in the 90s, till the 90s and even in 2000s. If you talk to most people, investing in markets was considered as a bad word. That's not a place to be. It was always considered to be negative. And if corporate India wanted to raise capital for growth, it was normally foreign portfolio investors in the 90s, and we saw it start with the GDR market. We were exporting our market. We saw the prominence of an unknown exchange in the world called the Luxembourg Stock Exchange become the place where most Indian GDRs were listed, and probably no other company in the world got listed on that exchange, or very few companies in the world got listed on the stock exchange. From there, the evolution of the QIP market, the private placement market, development of the secondary markets, progress on technology, moving away from the traditional Badla system to the new world futures and options. I have seen a revolution of scale and size which should make every Indian proud. And the question then, friends, is what do we do from here? And as we think about the fact that we have seen a massive shift of a traditional saver becoming an investor, what are the challenges in front of us to nurture this average Indian saver who has become an investor? And at the outset, I do believe that if you look at the two intermediation models, which is the saver-borrower model and the investor-issuer model, the investor-issuer model's intermediation cost is much lower than the traditional saver-borrower model, because the markets act as a perfect market mechanism to shrink the intermediation cost versus the traditional model. However, The investor issuer model has a lot of guardrails and challenges which it needs to meet in order to be able to sustain the investor issuer model. And it is subject to many, many vagaries and factors. And in this context, I want to talk about the largest and the most successful, and probably at this stage, the only icon which we can compare ourselves with is the United States of America, which has built deep capital markets and has created ability to manage large pools of capital. To an extent, the markets remain stable, even if a single stock moves in delta value of $250 billion in a day, more than the largest market cap company in the country, and everything works. However, when I go into that market and look at some of the developments, we should be concerned about the capital formation aspect of capital markets, the way the world financial markets are shaping at this stage. I think the starting point of the trouble really is the US dollar. It has just been enormously printed to support fiscal deficits. And as you get larger and larger on that and print more and more of that, it gives a unencumbered right to one country to be able to do things which no other country in the world can do. So one area which I think for India's sustained future is, I think a time has come for us to foresee over the next 10 or 20 years for India's true growth and development, is how can India look at improving its position on the currency side to get a larger and larger positioning as a potential currency of trade on its own capacity. With it comes, how do we lay the path for convertibility of the rupee? What are the institutional mechanisms we need to build? Because if we want true capital formation of the scale and size of the largest market in the world or anywhere near, and we aspire by 2047 to be the top 2 economy in the world, we will have to take the battle on the reserve currency on. And friends, nothing is permanent. In the early 20th century, there used to be a saying that the sun never sets on the British Empire. In a lighter vein, nowadays, if I talk to some of my friends in London, they are waiting for the sun to rise. So things have changed, and therefore, any country which considers its reserve currency supremacy forever, like probably Britain did once upon a time, and maybe US considers itself very comfortable, that's the time for a nation to build. And I genuinely believe if there's one country in the world which has the ability to build trust on a global platform and with strong institutional mechanisms, it is not China. And India has a shot to be thinking about this as a next 10 to 15-year project of what we can do. Because once we do that, it gives us a significant amount of ability to do things and build India at speed and scale like the US does. The fact of the matter is 60% of the world's market capitalization is the United States of America. And for getting there, the reserve currency has undoubtedly played a major role. The second important aspect for India's future in the context of building long-term capital for India's phenomenal growth needs is the concerns of what's happening right now in the US and the development of an alternate market currency, which is the crypto. And I think Chairperson SEBI has mentioned about this for daily settlement, that the future competition for markets is coming from there. Frankly, I am at a loss how gold or a crypto really creates capital formation. But investors are looking for protection of their capital, and they put it into this as a counter hedge for governments worldwide who misbehave and are irresponsible on the fiscal or monetary side over long periods of time. Therefore, you just have to look last 1 year's performance on crypto. It's 3x. 23,000, I was just looking at, to more than 70,000. And what does it create? And I just saw the UK, Europe, and even the US are legitimizing crypto as a major part of the future. And effectively, savings of investors are going into that and taking away very, very critical pools of resources which otherwise would go into capital formation. But investors are focused on protecting their value. Gold has kept its value over generations. And therefore, we have to be clear in terms of policy making and regulation. The saver and investor is not concerned about capital formation. The saver and investor is concerned about only his or her own capital and how that is protected from vagaries of inflation, poor economic policies, and protection for its future. And gold even now produces that 10% compounded return over a long period of time. Therefore, as we think about capital formation as a public goal, we have to be clear that there is a public policy requirement versus an investor who has a very different perspective, protection of his own long-term punji. That brings me to some of the issues that as we see the movement of the saver to the investor, it is the same person. Any of us, in a moment, take a decision, a bank deposit versus a debt mutual fund versus an equity share. So the individual changes in the mind from a saver to the investor. I'm asking the question that our system of regulation has compartmentalized the saver-borrower model primarily with one regulator and the investor-issuer model much more with the other regulator. So the saver is the same. The lens through which we are seeing the practitioners perform have different compartments, and what we have to be clear is that finally it is the same person which we are serving through different ends. And for sustained growth, we need to keep that. And the third angle, and I'm glad the Chief Economic Advisor was there, that in addition to the verticals on regulation, the third important player is the fiscal side. And as we build and nurture and build the guardrails of building a deep pool of capital markets which supports India's growth, as it has done for the last 40 to 50 years, into a new India with lower intermediation costs, there are some risks which we need to keep in mind. We have seen a phenomenal growth on the futures options, and I think a lot has been talked about that. And it reminds me of a famous, and this is not common, it's not about today, it's back in the 1940s, a statement of John Maynard Keynes, which went like this. Speculators may do no harm as bubbles on a steady stream of enterprise. The position becomes serious when enterprise becomes a bubble in the whirlpool of speculation. Therefore, what we need to keep in mind is the speculation is a core part of markets. But how do we ensure that the enterprise itself then starts manipulating things to get the speculation get to higher price? And this statement of John Maynard Keynes in the 40s, and it comes on the back of the Great Depression with the crash in 1929, is something which we always need to keep in mind as we think about balancing speculation with creation of capital formation and enterprise. And we have examples of that. I think the biggest example in recent times has been 1980 to 89 Japan. And it's only 35 years later that Japan index Nikkei has barely crossed its 1989 peak. And that's something which we need to keep in mind. But I want to at the same time say that I believe at this stage, we are nowhere near that risk. And there are enough checks and balances in our system today to compare ourselves in serious bubble territory. There may be early froth, as if I can use the phrase from what you said a few days ago, but I would say that it is still froth, little bubbly, but not out of control. That's my personal view. But as long as we keep a watch and manage it well, we can create a sustained capital formation going forward. I was very intrigued by also the numbers, I think, on the share of mutual funds and compared to bank deposits. 54 lakh crores, which is 26+% compared to bank deposits, which is 204 lakh crores. This number 10 years ago was 10% compared to bank deposits. So 10 has become 27. And if I am predicting something, before that, in addition to 26% of mutual funds, if you take AIFs and PMS, it's now a number which is close to 30% of bank deposits. And if we can put good guardrails, I have no doubt that this number in the next 10 years, from 30 combined, could go to 50% of bank deposits. And we need to nurture and build this for providing capital for enterprise and growth. That brings me to a second point, friends. For sustained capital formation, yes, of course, we need equity. But it is not a one-legged race. It's a two-legged race. And as has been mentioned, we need debt. And debt, of course, is coming from bank in the form of bank deposits, but also debt in the bond markets, in the REIT markets. And it is here that the tripod of the regulators plus the fiscal policy makers need to have a close working together. And to put it very bluntly, I think from the position of a saver or an investor, if I am taxed at 10% on equities, which I think is a good thing, because I think you need to encourage equity culture before it is misunderstood, I do believe 40% marginal tax on debt certainly dissuades every saver from considering the debt options. And therefore, we need to look at the gap. And I'm not suggesting any particular direction, but 10 to 40 is a very large gap in terms of outcomes. And it is therefore quite surprising that today, an equity trader in the markets with 6:1 debt equity can borrow at lower rates than a AAA corporate. So we need to look at the entire plumbing of how our financial system currently is to lead to a situation where both the legs of the market, equity and debt, work in tandem for sustained growth over a long period of time. And there is certainly some work to be done on that. And therefore, at times, the fiscal side has some very different choices. What is right in public policy versus what is right for their short-term revenue. And at times, the decision can be swayed, just as the chief economic advisor highlighted about practitioners in the market. We need to ensure the policymakers also keep a long-term view in their decision-making, where public policy focus of what is right is taken as much importance as the short-term revenue implications of their decisions. And this is, again, a genuine belief that in the context of the equity culture, I do believe that there has to be some streamlining of taxation across different classes, including on double taxation on dividends. And we need to find a way of equalizing the highest marginal total tax on debt with the total tax on dividends, which is a corporate which pays 25%, plus the tax in hands of the receiver, which total should not be more than the highest marginal tax. The fact of the matter is, highest marginal tax on debt is 39%. Highest marginal tax on dividends is effectively 57%. So we need to, from a public policy point of view, look at a sustained, pure public policy angle to ensure that capital gets allocated not on the basis of arbitrage, but on the basis of what is fair level of returns for the capital. And undoubtedly, equity is higher risk, therefore needs to be taxed de facto lower than other categories of capital, but not in a manner that it distorts the overall balance of financial markets. Just in that context, I wanted to also highlight often debate. The capital markets have been compared to what I call as the jungle, and it's the survival of the fittest. And then we have to make sure that the policy making modulates the jungle. But what do we want to achieve out of that policy making? Do we want it to be a perfect garden? Do we want it to be keeping the characteristics of a jungle with appropriate rules? How do we get this whole range of policy-making options between a free jungle to a perfect garden? And this is the debate which each of us has to ask, and where do we draw the line? If we make it a perfect garden, we will have a wonderful situation. What will it do to creativity and out-of-the-box disruption and change in facts, which are as important for a future as it is to ensure that whatever flowers there are, they bloom well? And I frankly believe that the answer is not an easy answer, and it's an answer of balance and equilibrium. The jungle has beautiful elements. It enables lots of things to flourish, which would never flourish in a garden. But it comes with, at times, rules which may not be fair for all. And therefore, we need to move to a balance between just the survival of the fittest to not moving to a stage where enterprise starts getting affected because of the situation and the policies which we do. And I'm sure regulators, policymakers will be always trying to sustain and struggle through these important differences. And on my last point, as I think about this future, I have no doubt that when we look at India 2047, there is a very strong ability for India to become the top 2 nation. And it is for us here to put the building blocks. I appreciate the number of areas which I think SEBI has made progress, including the whole area of REITs, InvITs, building new platforms, creating opportunity for players with diverse approaches, and keeping in mind that we want a perfect garden in a wild jungle. With that, I'll say thank you very much, and I'm truly honored to be here on this occasion. Thank you.
Thank you, sir. Thank you so much for your words of wisdom. May I request Chairperson SEBI to please present a memento to our keynote speaker, Mr. Uday Kotak. Now I invite Shri Tirthankar Patnaik, Chief Economist NSE, to deliver the vote of thanks.
Ladies and gentlemen, I extend my deepest gratitude to our esteemed guests, Dr. V. Anand Nageshwaran, Ms. Madhabi Puri Buch, Mr. Uday Kotak, for gracing this occasion and sharing their valuable thoughts and insights with us. The points you put forward have been truly informative and thought-provoking. I would also like to express my sincere thanks to NISM Director, Shri Ashwini Bhatia, and SEBI whole-time members for giving us the opportunity to host day 1 of the SEBI NISM conference. I thank the organizing teams at SEBI and NISM for their meticulous planning, tireless efforts, and unwavering dedication in bringing this conference to fruition. I'm absolutely and extremely grateful for the cooperation we received from our colleagues at NSE in ensuring smooth logistics and technical support. The planning for this conference began much in advance, and we truly appreciate your support throughout this time. A special thanks to our MD and CEO, Shri Ashish Chauhan, for his support and guidance. Lastly, certainly not the least, my heartfelt thanks to every one of you, our participants and attendees here, for accepting our invitation to participate in this conference. It's our pleasure to host you as guests. I wrote some of the notes from each of the three speakers. We got a sense of the scale of capital formation in this country over the last few decades, the importance of growth for sustained capital formation, how we should be seeing beyond just short-term gratification, the true meaning of mindfulness and living in the present from Dr. Van. We also saw the relevance of monetization of real assets from Madam Chairperson with fractional ownership a la financial assets. We also saw the importance of seeing the saver and investor as one person in the saver borrower and the investor issuer models. The saver and investor, I wrote here, is not worried about capital formation alone, but more importantly about his capital, its protection and growth, the importance of debt in the bigger scheme of things, including taxation, the importance of keeping the long term in mind again, and the balance between, sir, the garden and the jungle. Thank you. I will, as a mark of our gratitude at NSE, may I now invite our MD and CEO, Shri Ashish Chauhan, to felicitate everyone on the dais. Thank you, sir. Ladies and gentlemen, that brings us to the end of the inaugural session. We'll break for tea at this point. Thank you.